Hello class, and welcome to the video lecture for Accounting for Bad Debts. The first learning unit talks about how the bad debt expense and allowance for doubtful accounts are used to record bad debts. Bad debt expense is a general ledger account with a normal debit balance, just like all other expense accounts. This also means it's a temporary account that's closed to income summary in the closing process, just like other expense accounts. The term bad debt means an account receivable that won't be paid. For example, if you receive a doctor bill and you don't pay it, the doctor's office considers it a bad debt. Allowance for doubtful accounts is a contra asset account that accumulates the expected amount of bad debt. It's contra to accounts receivable. Remember when you learned about accumulated depreciation in Accounting 110? Accumulated depreciation is also a contra asset account, contra to long-term asset. Since allowance for doubtful accounts is a contra account, it has the opposite normal balance of an asset account, so it has a credit normal balance. Also, like other asset accounts, it's permanent and is never closed to income summary. Let's look at the basic journal entry. A company estimates that 1.6% of its sales of $100,000 will not be collected. 1.6% of $100,000 is $1,600. This estimate is recorded as an adjusting entry at the end of the year. We debit bad debt expense and credit allowance for doubtful accounts. The bad debt expense of $1,600 will appear on the company's income statement for the year in the same year the related sales revenue was earned, which matches revenues to expenses. The allowance for doubtful accounts will appear on the company's balance sheet listed right under accounts receivable to show that the company doesn't expect to actually receive the entire amount of accounts receivable from its customers. This is how allowance for doubtful accounts is presented on the balance sheet. Notice that it's listed in a separate column, so a subtotal of accounts receivable minus allowance for doubtful accounts can be shown in the right column, along with the totals of other assets. This subtotal is called net realizable value. It means this is the amount the company expects to realize or receive from customers. Now let's look at what happens when a customer doesn't pay his bill of $200. It's the next year, June 5th. We had estimated the previous year that $1,600 wouldn't be collected, and this $200 is part of that, so we reduce allowance for doubtful accounts by $200. Then we reduce the customer's accounts receivable for $200 with a credit. This process is called writing off an account. So that concludes Learning Unit 1. In the next Learning Unit, we'll cover how to estimate the amount of bad debt.